Hello and welcome to Simply inTAXicating. In this episode, second episode on indirect tax, we are going to touch upon various amendments proposed in the finance bill in the Indian budget 2015-16. We'll go straight to our Hyderabad office where our in-house experts, Mr Vijay Kumar and Mr Raghavendra Rao, are going to talk about the nitty-gritty of those changes proposed, the technical aspect, the debatable aspect, some of the rationalization, some of the issues, expressions, for instance, like exports. What is exports? For the first time in this finance bill, the expression exports has been given a definitive definition. Then, of course, the time limit for availing CENVAT credit, time limit for availing credit on capital goods, and of course, pruning the negative list. Two distinguished guests will be joining Mr Vijay Kumar at our Hyderabad office. They are going to talk about some of the proposed changes by Mr Jaitley and how they are related to the proposed GST rollout next year. So let's go straight to Mr Vijay Kumar, who is going to explain some of the budgetary provisions in the Union Budget 2015.
The central excise rules. Under the rules now, they have permitted maintenance of records digitally, and even the invoice can be now signed digitally. What is digital signature? How to go about it? The conditions and procedures are to be notified by the board. Wait for the board's instructions. What is export? Just like what is manufacture, what is tax, what is service? This is another issue that has belied a proper definition all these years. Now, in central excise, when goods are exported on payment of duty, the duty paid is refunded as a rebate. Similarly, if the CENVAT credit cannot be used and the CENVAT credit gets accumulated because of export, a refund of the CENVAT credit accumulated is also given. But the goods have to be exported. Now, in the central excise department, there is a concept called deemed exports. Exports to SEZs, 100% export-oriented units, are considered to be deemed exports. Now, if an SEZ unit imports goods, it can get them without payment of duty. Why can't it get the same concession when it buys from an Indian manufacturer? So, the Indian manufacturer should also get a benefit of export. So, all these days, there was some litigation on whether deemed exports, that is clearances to SEZs and EOUs, are considered to be export or not. Now, once and for all, the government clarifies that export means the goods should leave the country, no deemed exports, and so you cannot get rebate if the goods are not physically exported. Under the rules, you are required to file returns regularly. In the earlier regime, if you don't file a return, the department had to give you a show cause notice and then perhaps impose a maximum penalty of rupees 5,000. Now, there is no need of a notice. If you don't file a return within the stipulated time, from the day after, you have to pay a penalty of 100 rupees per day, subject of course to a maximum of rupees 20,000. In central excise, you are required to file several returns starting from year 1, 2, 2, 3, 4, 5, 6 and what have you. If you don't file a return, the present practice is you are issued a notice and then the adjudicating authority imposes a penalty of maximum 5,000 rupees. Now, this system is gone. If you don't file a return within the stipulated time, now from the day after the stipulated date, you will have to pay an amount of rupees 100 per day, subject of course to a maximum of rupees 20,000. Some important changes are made in the CENVAT credit rules also. one which would be welcomed by the trade and which was vociferously demanded by several assessees was the rule introduced last year that CENVAT credit has to be taken within 6 months from the date of the prescribed document. Now the 6 months period is enhanced to 1 year. This would be welcomed by all the assessees, and those who have lost the credit because of the 6 months restriction between 6 months to 1 year can now take that credit. Earlier, capital goods sent to job worker had to be returned within a period of 6 months. Now this period is enhanced to 2 years. There has been a controversy on exempted goods and non-excisable goods. If you are using inputs in the manufacture of exempted goods as well as dutiable goods, there are several conditions or restrictions that you will have to bear with, like maintenance of separate accounts, payment of an amount, not taking credit at all. Now, does this apply to exempted goods or does it apply to non-excisable goods also? If you are manufacturing excisable goods and non-excisable goods, and if you are using common inputs, you are doomed. You cannot use it, and you will have to follow one of those requirements. For now, the government says exempted goods include non-excisable goods. You must all be perhaps knowing the famous IndSwift case, where it was held that CENVAT credit taken or utilized for interest to be paid, it is enough if the CENVAT credit is taken, even if it is utilized or not. The government had amended the law. This issue had gone through several courtrooms, and finally now this year they want to make the distinction. If you have taken credit and even if you have not utilized it, the credit will be recovered as per the provisions of section 11A, and all the consequences follow, which may include penalty. Central excise registration. Getting a central excise registration or getting the central excise existing registration cancelled is one of the most difficult things to happen in the department. Now the government says, the board says it has simplified the registration process. The registration will be granted within 2 working days of the receipt of the duly completed application form. The verification of the premises will be done post issue of the registration. Insight into matters relating to service tax, I invite my colleague, consulting editor Raghavendra Rao.
Thank you, sir. One of the major changes proposed in Finance Bill 2015 with regard to service tax is enhancement of tax rate from 12.36% to 14%. This 14% is not with immediate effect. This will come into force only from a date to be notified after enactment of the Finance Bill. Till such time, the existing rate of 12.36% will continue, and the assessees are required to pay education cess as it is till the new 14% will come into force. There is also a proposal to levy a new cess called Swachh Bharat cess at 2% of the value of service provided. Please note that this 2% is not computed on the service tax amount, but it is computed on the value of the service to be provided. That means with effect from the date to be notified, if Swachh Bharat cess is also included, the gross rate of service tax will be 14% plus 2%, that means 16% on the value of service provided. Now, certain services are to be included in the tax net by making amendments to negative list existing under section 66D at present. Now, these services which were hitherto not taxable, they are now brought under service tax net, like admission to entertainment events or access to amusement parks. Till now, support services provided by the government to business entities, they were covered under service tax net. This scope is proposed to be expanded to include all services provided by the government to a business entity, whether they are support services or not. Suitable amendments are proposed in the negative list. An explanation is proposed to be inserted in the definition of service to clarify that services in relation to chit fund and distribution agents, selling agents of lottery, they are covered under the service tax net. This is to take care of certain judgments wherein it was ruled that these services are not covered under the existing provisions. An illustration is proposed to be inserted in section 66F, which explains that any reference to a main service does not include its input service. For example, services provided by RBI, they are covered under negative list. It does not mean that agency services provided by other banks to RBI, they are also covered under negative list. So, they are taxable. To explain this, an illustration is proposed to be inserted in section 66F to make things clear. Certain exemptions are proposed to be withdrawn by amending Mega Exemption Notification 25 of 2012 to bring certain services under tax net. For example, construction services provided to government in relation to non-commercial buildings, schools, hospitals, these were covered under exemption. Now, these entries are now deleted, thereby making these services liable to service tax. Similarly, construction of port or airport, the relevant entry is also deleted. So, these services will now attract service tax. Exemption to service provided by performing artist, earlier it was completely exempted. Now, the scope of exemption is limited up to a value of rupees 1 lakh received per performance. Transportation of foodstuff is exempted under notification 25 of 2012. This notification is proposed to be amended to limit the scope of exemption only for transportation of milk, salt, food grain, including flours, pulses and rice. The other items which were earlier covered like tea, coffee, sugar, milk products and edible oils, this exemption is withdrawn now. So, transportation of these items will attract service tax now. This is effective from 1st April 2015. For certain services, the service recipient is liable to pay partial liability like manpower supply and security services. Till now, the liability of the service recipient is 75% of the tax payable. There is a proposal to amend this notification to make it 100% reverse charge. That means, manpower supply and security services provided by specified service providers will now attract 100% service tax in the hands of recipient of the service. This notification will come into effect from 1st April 2015. There are certain changes in abatements. For transportation of goods by vessel, rail or road is now, the abatement is now made uniform at 70%. That means, the liability of the service provider is only on the 30% of the gross amount charged. The impact of this amendment is mostly the goods transport agencies where the abatement is now at 75% and they are paying service tax on the 25% of the gross amount received. So, that is now slightly increased to 30%. Again, Rule 4.7 of CENVAT Credit rules is proposed to be amended to make an assessee who is paying service tax either partially or fully under reverse charge, he can take credit after making payment of the service tax. Earlier, the partial reverse charge service recipients, they can take credit only after making payment of the value of service to the service providers. Now, there is a relaxation. The moment they pay service tax under reverse charge, they can take credit. Again, this change will also come into effect from 1st April 2015.
Let's take a short break, and after the break, we will go back to Mr. Vijay Kumar. A very distinguished guest will be joining him. He is a noted exponent of law and a former president of FAPSI, Mr. Thirumalai. He is going to talk about what compelled the finance minister to hike the service tax rate so substantially, such a huge jump, and how it was inevitable vis-a-vis the proposed GST rollout. Welcome back. We will go back to Mr. Vijay Kumar, who is going to talk with Mr. Thirumalai with respect to some of those important issues related to proposed GST. And what runs through the entire GST structure is, of course, the seamless credit chain. Mr. Thirumalai is going to talk about some of the legislative aspects and the constitutional technicalities involved in the entire issue, and of course the GST bill.
I have with me a very distinguished expert, a former president of FAPSI, an advocate by profession, a chartered accountant also by qualification, a former director in a huge corporate entity, and also at present a director in another company, the very distinguished, knowledgeable Mr. Thirumalai. Welcome, sir.
Thank you.
I would like you to touch upon this huge increase proposed in service tax.
Well, if we want GST, it is necessary that we should reach the revenue neutral rate of GST, both on the excise side as well as on the service tax side, sooner or later. What is the revenue neutral rate going to be? Is it going to be different for services and goods, or is it going to be the same? At least for now, based on the information in public domain, one could say that we will have a rate which is common for both goods and services. Of course, there could be a band in the standard rate which is available for states to play around with, limited band. That is the information in public domain so far. But the fact of the matter is that we have to reach there. And if you look at some of the studies made by the National Institute of Public Finance and Management, NIPFP policy, they had suggested something close to a summation of the excise duty and service tax after detailed study, 25–26%. It is not the rate that is important, it is the seamless credit that is important. Have we created the environment, the necessary ground conditions for the purpose of seamless credit? And if I look at the changes that have been made, particularly in the context of pruning of the exemption notifications, bringing in service tax on packaging and processing of potable liquor, and the changes that have been made in the context of services to government in the area of construction, original works, and also the changes that have been made with regard to non-eligibility of service tax exemption when you render construction services for ports and airports. Obviously, there is a clear signal, because in the GST regime, construction is outside the GST. Real estate and construction is outside the GST. They are not entitled for input credit because property tax is still very much a state subject. Registration is a state subject. So, therefore, the question that comes up is,
But then, sorry for the interruption,
Yes.
sir. But how do you visualize that intoxication, alcohol? You have mentioned about alcohol.
Yes. Why?
Where does that fit in?
Yeah, where does that fit in? That fits in if you look at the definition under 366(12)(a) of the Constitution Amendment Bill, 122nd Constitution Amendment Bill, which talks about goods and service tax as something, a tax other than on alcohol or liquor, processes relating to alcohol or liquor.
Right.
Taking advantage of that and very much encroaching, if I may say so,
Exactly.
into the field of occupied by Article 50, entry 54 of the second schedule, list 2. They have now taken power to levy tax on the process of potable liquor. These show very clearly that while they have deeply studied the contours of the constitutional bill and to see what can come within the purview of GST, because this is going, other forms of liquor, particularly human consumption, are going to be outside the purview of GST and within the realm of states. So, therefore, they have carved it out so well and taken potable liquor as something which should be subject to service tax. Now, coming back to this point of the movement, as you asked, from 12 to 14, 12.36 to 14, 14 to 16, where should we go? Is it 18? Is it 20? And as I said, it is on the one hand all the restrictions on input credit which we saw in 2011 and then followed in 2012 have been kept, including certain regimented positions in the context of availment under by way of what is utilization under Rule 14. All that I am mentioning is that on the one hand the seamless credit seems to be curbed in the transition process, whereas the avenues of revenue which may accrue as a consequence of moving to GST to both the center and the states, of course, are being carved out and taken. And those exemptions which are outside the purview of GST, like construction sector, alcohol and liquor, those have been completely kept out in terms of the exemptions that they enjoy. So, the point that comes up is right from 1/7/2012, when we had the point of place of provision of service rules, amendments were made ahead of time, but GST is yet to arrive. And my own calculation is that if you take the normal process by which all the 29 states have to pass their own legislations, and these will have to come into force after forming of the GST Council, which should make the recommendation on the most important revenue neutral rate, which is what we are talking about when you say 14 becoming 16. It is nothing but the revenue neutral rate. It has to move towards the revenue neutral rate, and that process is going to take at least till the middle of 2016, according to me.
April 2016 is
according to me, it is even on a very tight day-to-day monitoring, and since 60 days the GST Council is the only one that has to make this recommendation, though it cannot take away the sovereign powers of the 29 states, but it has to make a recommendation, and that recommendation is only after the bill is passed and assented. And therefore, even a very tightrope situation, according to me, seems to be middle of 2016. But if you put in all the force that is required with all the consensus that is required, possibly 1st of October is something which is not out of reach, but very, very tight, according to me. And therefore, the issue that comes up is, while the rate increases have progressed, the other ground conditions of making the transition less harsh, if I may use that expression, are not present there. We have removed the exemptions, we have kept the curbs on input credit, and we have also gone to the extent of saying that even amusement parks entertainment, which is all under entry 64, list 2. Those have been again brought within the purview, like potable liquor. These are examples to show that wherever carving can be done and taken out for the purpose of augmenting the current revenues, those have not been given up.
You mean to say he has taken whatever he can without giving anything, and you are not even sure of the GST coming at least in April 2016. So the promised GST is not coming, but the liabilities or the harshness is on me now. Is that what you mean?
I mean that the seamless credit, which is the crux of any GST system, must also be indicated. What is the point in only indicating that your rates will go up? We will carve out and take whatever is possible into the GST system, because we have got a very peculiar GST where bulk of the items like petrol, petroleum products are out of it. Construction industry, real estate and construction, which is part of that, is out of this. So therefore, the crucial question is, it has become, according to me, one-sided in somewhat normal expression, in the sense that we could have also shown how seamless credit, of course, it is going to have an immediate impact on the revenue realizations, 45,000 crores, which is what service tax should yield according to the receipts budget, inclusive of the rate increase which is there, is going to be affected by that process. But that is the investments that should have been made for preparing all of us. Because if you look at the GST situation, where a huge lot of dealers, traders are going to join this, 62% of them are less than 25 lakhs. You will ask them to file returns, you will ask them to go through a line by line matching process for the purpose of adoption. Where are you going to end in terms of thresholds? Because these will have again an impact on the revenue neutral rate. So I think that while the rate increase had to happen today or tomorrow, in the wake of GST.
You are all for that, but
yes,
you want the credit.
The ground conditions also should have been, a little bit of that should have been given to us. Like for example, why continue with rent-a-cab being not eligible for credit? General insurance not being eligible for credit except under certain circumstances. They will all be business related credits which should have been allowed. Then that would have shown the indication, balance, that yes, we are on the right road. This is the observation. Rate had to increase today or tomorrow in the wake of GST, and if we free that the promise of GST of 1 to 2% increase in GDP is really going to be captured and must be captured. If that has to be done, the sooner you deal with it, the better. And this opportunity, I think, is not lost, because the rules can be amended at any time in terms of the CENVAT credit, and also put in place the B2B and B2C rules which must come in, not just the POPS that we had in 17/2012. What is the business to business and business to consumer rules that are going to come in? Why keep it in some back room? Why not share with the so that we can also contribute in the context of this path to GST.
Thank you very much, sir.
Thank you.
Generally, in every budget, you see a retrospective amendment to undo the decision of a court. The policy of the present government is not to impose taxes retrospectively, but they can still undo the decisions of the courts prospectively. There is one such provision in the finance bill regarding the valuation of service tax. I have with me Mr. Shankar Bala, Senior Advisor, Tax and Regulator Services of E&Y. Mr. Shankar, welcome to TIOL. Please tell us what this valuation is all about.
Thank you, Mr. Vijay Kumar. Thanks for this opportunity. As you correctly hit the nail on the head, ostensibly the amendment which has been made to Section 67 of the Finance Act so as to bring within the ambit of value of services reimbursable expenditure is to undo the judgment of the Delhi High Court in the case of Intercontinental Consultants. The Delhi High Court, as you are aware, had struck down Rule 5 of the valuation rules as going beyond the provisions of the statute. It's a moot point that still after this amendment, this law is still challengeable, because if you read the Delhi High Court judgment carefully, it also says that 67 itself is subject to the provisions of Chapter 5, which includes Section 66. And in so far as 66 only mandates tax on services, 67, to the extent it goes, with the amendment, to the extent it goes beyond the purview of 66, is still challengeable. I mean, to my mind, this undoing this judgment of Delhi High Court, so ostensibly so, but may not really serve the end purpose.
So for our viewers, if you can explain a little bit about what exactly has been done.
Okay.
What was the provision and what has been done?
Sure. Even as the statute calls for levy of service tax on the value of services, the value has been extended to include also additional costs and expenses which are incurred in the course of providing the taxable service by means of Rule 5 of the Determination of Value of Service Rules 2006. So what happens is there are also expenses which are reimbursable, expenses which are incurred over and above the value of services, which are also includable. Like, say, let's take an example of, say, air travel.
Right.
The air ticket value is also to be included. Of course, there are abatements provided. We are not going to those abatements now. But the value will also include, the value of the service is only giving you a ticket, but it also includes the value of the ticket. So to that extent, Delhi High Court had said that you cannot include the value of those which are not related to the service. You can only tax the value of the service and not costs or expenses which are incurred in course of, because that goes beyond the provisions of Chapter 5, Section 66, which is in Chapter 5. So that has been undone to say that we will bring it, the value has been redefined to include reimbursable expenditure.
You mean if your client reimburses you the air ticket, that has also to be included in your fee?
Yes, I mean there is an abatement provided elsewhere.
Right, okay, fine. But otherwise the value should include the air ticket also.
Absolutely right. I have one more point to make actually, besides this legal.
Can I ask you a question?
Yeah, sure.
Now suppose there are consultants who charge slightly more than the air ticket, then what happens? Say air ticket is 10,000 rupees, I charge my client 12,000 rupees.
The entire value is includable.
It's includable. I mean, according to you, this is challengeable, and at least the 10,000 is not includable.
Correct.
Because that's not service at all.
Yeah. The balance 2,000.
But what about 2,000 rupees?
Yeah, that should be chargeable. That should be chargeable. Because it's really not an expenditure, or it's really a form of fee.
Right. Yes, sir. You were saying something else.
Yeah. No, I was saying that the word used is reimbursable expenditure.
Right.
So, which to me, I mean, if you look at from the point of view of an accountant, it must have gone through your profit and loss account, in the sense that it must be your expenditure and you are getting it reimbursed.
Right.
But if you debit that to the client off, straight away on the threshold,
right,
and don't route it through your revenue account, P&L account,
okay,
then it should not be a part of expenditure at all, because this is not a question of reimbursement, because it's not an expenditure. This is an amount you are incurring on behalf of the client.
That's a wonderful point that you are making. This means for my air ticket, if it is 10,000 rupees, I pay 10,000 rupees, I give the ticket to my client, ask him to pay, reimburse that 10,000 rupees, finished, it doesn't come into my accounts, it's okay. But if I show it in my accounts and then bill it to him, you call it expenditure?
Yeah, that's what the law, that's a loophole in the law, that's what I mean.
So is this loophole going to be beneficial to the service providers or to the government?
Ideal will be not to route through your profit and loss account.
That is the ideal system.
Yeah.
Fine. No, but do you think their intention was perhaps always to tax all the expenditure. And I mean, assuming this is an expenditure. When a court says it's not so, they are trying to change the law. Is it right?
Yeah, but you can only tax the value of the services. You can't tax the value of those which are our neighbor services.
So you perhaps hope or expect that this will also go the intercontinental way.
I think
through
so.
the Delhi High Court.
That's what I said right at the beginning, saying that because in any case, even if 67 is amended, so long as it violates 66, which is the charging section, I think it will go the intercontinental way.
So that goes on to prove that lawmaking is not all that easy. You can't just undo a High Court order by
stroke of pen.
By stroke of a pen.
Yeah,
you need
right. Sure.
better lawmaking techniques.
Absolutely.
Thank you very much, sir.
Thank you.
It was very nice talking to you.
I appreciate it. Thanks.
Thank you, Mr. Vijay Kumar, Mr. Thirumalai, and Mr. Shankar Bala for sharing wonderful thoughts, wonderful interpretations of some of the indirect tax related amendments proposed in the budget. Let us hope the Union Finance Minister, Mr. Arun Jaitley, pays little attention to some of the areas which have created confusion with respect to, for instance, Swachh Bharat says that confusion should be taken care of. Secondly, the key points which have been raised by Mr. Thirumalai with respect to the GST rollout. Very rightly, he pointed out that the Honorable Finance Minister has, and he was expected even before the budget, to hike the rate in order to move towards the proposed GST. But he should have also given clear signal to the industry by making corresponding changes in the CENVAT credit rules, by extending the scope of CENVAT credit to some of the services on which is of course a cost to the business, the industry is not eligible to able credit. I'll also agree with Mr. Thirumalai that the deadline for GST rollout is apparently very tight. Even if it is monitored on a day-to-day basis, it will be difficult to catch the April 1st, 2016 deadline. Let's hope that Honorable Finance Minister is able to run a little faster and catch the deadline. Apart from that, what was pointed out Mr. Shankar Bala, hopefully the North Block will take care of that aspect. And some of the other provisions in central excise where the industries have expressed their concern and the domain experts have also pointed out. Let us hope those issues are technical aspects are taken care of. Thanking you for watching us.